Hi everyone, this is a screencast for Independent Colleges Dublin for F6 taxation for December 2014. And this particular third screencast covers the CGT area, question 3 within the mock exam. Recently held. So you'll see from the body of the question, I'll take you down it in a moment, that this is a fairly standard format for question 3, the CGT question, with 5 different assets and details on those assets. And really what we're required to do obviously is to deal with each of the sort of tricks and rules included within each of the paragraphs 1 to 5. So in terms of the requirements, again, a fairly straightforward requirement, as you'd expect. Just compute the gains and losses, and specifically they've asked you to state why an asset, a particular asset, isn't taxable, isn't subject to a charge of CGT. That's a little bit of a prompt for you, really, to suggest that there may be an asset or possibly more that are not subject to. So do make sure you do that, or you will not get the marks that you deserve. Okay. Second part is just really admin, which I won't focus on too much. Fairly straightforward. We know that the tax year for CGT purposes is split into 2, and they've asked you to really see if you can recognize what's payable and indeed when, based on those 2 split periods. Okay. So if we look at the body of the question and these sort of 5 assets that they've given you, these sort of 5 tricks, as it were, you'll see that in the first instance we have 2 individuals, and do bear in mind that although that they're a married couple, and certainly for IT purposes they'll be most likely assessed on a joint assessment basis. Certainly for capital gains tax, they'll each have their own AE, their own annual exempt amount, and therefore we need to watch for which assets are relevant to each individual. Other point here is in relation to their sort of residency and domicile status. Now, normally that's not overly important, but in this particular case, it is in relation to one of the assets. In fact, the very last asset, asset 5. Okay, so more of that later. Let's deal with this first one here. They've started with something that students don't tend to like. It's actually development land. And really, how do we know it's development land? Well, it's this phrase here. As soon as we see current use value, we know that I guess that there's something fishy going on. This issue of development land has raised its head. And really, what does that mean? Well, it essentially means that the land has a value, or a current use value, which is in effect different from what you would call its development land value. Okay, so there's some sort of differential between, what some people would call the sort of normal market value and its development value. Okay, so what we're told is that the asset is sold for 30,000. One thing to bear in mind, that the proceeds are always the proceeds, even in a development land question. We know that the land is development land, and all that the difference on the disposal date tells us is it just reconfirms that the land is development land, but there's no real adjustment that we need, as I say, and you'll see this with the answer, that the proceeds are taken as 30. The next thing that they do here is give you some details, and this is certainly of interest in relation to how the asset was received, as it were, by Mark, and it was received in relation to a gift by his brother, and we know that gift rules for CGT purposes are always looking for the MV value, the market value. Okay. Now the problem that we have is that because it's development land, there's a differential between the sort of development land value, they're actually calling it the market value, and the current use value. There's a differential there. Now we do have to make an adjustment for that. The other thing that they do here is give us some details in relation to the historical cost from Mark's brother, and that was really just a red herring, because in effect at the date of the gift, that's when the asset becomes Mark's, and what we're interested in is the value at that date. Yeah, certainly the normal value, and indeed the development value. So really these figures are given just really to confuse us. We're not really interested in anything that happened prior to May 2001. Okay, so we'll deal with the bones of that answer in a moment. Next one here, we have another very, very popular area within capital gains tax, this idea of part disposals. And within this particular asset 2, this acres of farmland, what they've done is just put a slight twist on it, in the sense that they've given us the balance of the disposal in our current tax year, but they've actually made a disposal in May 2004 of the original 15 acres. And really what we're required to do is to go back to May 2004 and calculate what cost was extracted really from the cost value down here. So in essence, it's very, very simply the A over A plus B formula as we know it, but a little bit of a twist in terms of the sort of timing of when that's being used. Okay, more of that when we look at the answer. The next two items, 3 and 4, are really, again, something that gets examined regularly and does tend to confuse students, because there are some quirky little rules in relation to chattels, whether or not they're wasting or indeed durable. In the first instance, we have a gift, and we know that we're looking for market value there, obviously. And over and above that, we have some proceeds of, or a market value in effect of 2,800 euros, and indeed some enhancements to it. So we just have to figure out, well, what type of asset is this, and is there any rule that we have to apply in relation to this type of asset? And in fact there is, and it's really a marginal relief calculation that we have to do. Okay, the next one, similar sort of thing here, although a slightly different type of asset. We would have had to pick up on this area here that it's a pony. What type of asset is is it a durable chattel, or is it a wasting chattel? If it is a durable chattel, then what are the rules in relation to it, and is it exempt, is it chargeable, etc. So a couple of quirky areas there for us. This final one here is actually looks a little bit more complicated than it is. I mean, really, I always say that when we're looking at capital gains tax, that the important thing for us to do is to ensure that in some way, shape or form we get the three-liner out on the page. And if we'd stuck to first principles with this one, leaving aside the issue of the remittance at the moment, if we'd stuck to first principles, really it wouldn't have been too difficult to get some quite easy marks here. We can see that there's disposal proceeds of 150. We can see that there's a cost of 100, and then some more costs in terms of legal fees of 4, and we can also see that there's an enhancement. So really on first principles we would have been able to gain quite a lot of the marks just really for laying out a fairly straightforward three-liner, obviously subject to any indexation relief that's relevant. Then what they do is they tell us a little bit about this issue of a Spanish bank account. And you remember above that they talked about residency and domicile, and they said that both Mark and his partner Sarah are both resident and domiciled. And really, I think what they're trying to do here by talking about an issue of remittances is really throw a curveball at us, as if to say, is this relevant in any way? And really what we should remember that for F6 purposes is that where an individual is resident and indeed domiciled, then they're going to be taxed on their worldwide income. So the extent to which they remit monies in relation to foreign earnings is completely irrelevant. And so this 100,000 isn't relevant to us at all. Okay, and we'll see that within the answer. Next point here is in relation to just some losses, and they pull a little stunt here in relation to their terminology. They talk about non-development land, and that may throw some students off, but if we read it slowly, we can see that if it's non-development land losses, then it's normal losses, and that must mean that this 10,000 can be used in really any way that we want, because it's not relevant to development land, really no restriction at all. Okay, so that's the body of the question. Let's take a quick look at the answer now. And you'll see from the answer that, again, it follows our pretty straightforward format where, we're just laying out a heading up the top here, and then just the assets down, literally one by one. Okay. Now this first one may have caused some students some difficulty, but what you'll see is that, and you probably won't see this in your study text. What they've done here is that they've split the current use value and the development value into two parts, really. Now they didn't have to do that, and the reason that we've done that, hopefully that you'll know now, is that really, the current use value, the cost element, can be subjected to indexation relief, whereas the balance cannot be. So you'll see that this 11 and this 15,000, if you add that, you'll get the full cost. Okay, so really all that they're doing by splitting into two columns is saying, okay, well, the proceeds are all in there, yeah, the 20 and the 10, and for the cost side, what we're going to do is only apply indexation relief to the current use element. We cannot apply it to what we call the development value. Okay, and hence the reason for two columns. So really, what do they do there once they've done their little workings? They just add these two figures together to get 3043. So really, that's all that we needed to do. Key point is no IR in relation to a development use value. And in addition to that, we can ignore any split really between development value and indeed current use value on the proceeds themselves. Okay. Now the next point is in relation to our part disposal for Sarah. Note that they're making a point of making it known who the asset is owned by and therefore who the tax will be attributable to. So for Sarah, what we had to do is to recognize the fact that there had been a part disposal several years ago, in fact in 2004. Okay. So really, if we're selling the balance, as it were, in our current tax year, really what we've got to do is to find out what this cost is in our year. And how do we do that? Well, the only way that we can do that is to go back to 2004 and to say, okay, well, if that was the original cost, then what element of that was in effect costed out in 2004? And what they've had to do is really to take those acres and really apply their A over A plus B formula, which is simply just proceeds over proceeds plus remaining element. Okay, and by doing that and by applying that formula to the 400, they get the value of the cost that was taken out in 2004. So if they take that 270, take it off the original cost, they get the balance that is left. So this is really the balance that is left in our current year. So a slight twist on the A over A plus B or part disposal formula, but not overly complicated. So just work through the logic of that and see that really that cost comes up here, IR is applied to it, and then we have a simple three-liner really. Quite a lot of marks as well, 3 marks available. Okay. Now 3 and 4, as I've mentioned, were the chattel rules, and the first one was really in relation to a durable chattel being sold at a gain or a profit. And what we have to recognize there is that certainly there is a simple 3-liner to do, including some enhancement, obviously some IR as well, to get to the gain figure. But the key point was to recognize that where we're selling at a gain, we have to do what we call a marginal relief calculation. Okay, and really how do we do that? And they do it here. We just apply this exemption limit of 2540. So we take the proceeds above, or in this case the market value, we find the difference, and we in effect apply the tax, okay, at 130. So in effect what we're saying is that there's an adjustment required because of a marginal relief element, and we need to allow for it. Okay. Next point is in relation to another asset that was either going to be a wasting asset or perhaps a durable asset if we didn't know. I think it was a pony. And really what we've got to say there is that if it's a pony, and clearly it is with a useful life of less than 50 years, given that it's a non-business use asset, then it will be completely exempt. We're going to get 1 mark for making that point. Do bear in mind that you shouldn't simply exclude it or ignore it, because you will not get that mark. Make the point of laying out point number 4 and saying that it's non-taxable. Next point, number 5. Again, as I look through the question, you'll recall that I said that this was a fairly straightforward calculation, and it is in the main, because really what we've got here is a simple 3-liner. We can see the proceeds in the question. We've got some costs that we're going to deduct, and we're going to apply our IR to get 113. And obviously the difference is the 36. Now, in relation to the remittance, as I said when we looked at the question, certainly the individual I believe Mark is resident and domiciled in the state, and therefore that individual will be taxed on their worldwide income. So any remittance of foreign gains or foreign income is totally irrelevant. This point here in relation to the furnishings, I think, have been a difficult half mark to get. It's highly unlikely that students would, or many students would have dealt with that point. So nothing to worry about there as such. Okay, so that gives us the main sort of assets, the main 5 as it were, and all that they do within the computation is just simply list them as you would expect, and really apply the AE and indeed the losses for Sarah to get the tax payable of 731 and 3594. Okay. In terms of the admin side, again, as I mentioned within the question, I'm not going to dwell on this too much. Really, what you'll see is that the tax year is split into 2 parts. Obviously, 1 Jan to 30th of November, payable on 15th of December, and accordingly, the last month payable on the following or the end of the following month, 31st of January. Okay, that's a quick summary for you on this question 3 CGT. Hopefully that's been helpful. Many thanks.